Well, let's stick with this topic. The oil and gas stocks, they're going to be in focus. Remember, yesterday, we had gas stocks that were on fire on the PNGRB proposed amendments to the gas transmission tariff regulations. And today we have news on the curtailment put on Venezuela or Venezuelan oil. Probal Sen, the senior research analyst at ICICI Securities, joins in. Hi, Probal. Thanks a lot for joining in. Give us a few details. What's the percentage of imports coming in from Venezuela for India? We understand it's relatively small. Do you see this as a risk?
I think, while exact real-time data is difficult, but my understanding is that India imports close to about zero point 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or even Russia, for that matter. But the fact is that if the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. And, to basically find 250,000 odd barrels of oil per day is obviously going to, take its own time. But from a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically manage this hit from what we get there.
So not a big challenge on this aspect. Another aspect, I wanted to focus on is the OMC LPG losses. And now there's a couple of reports, by Money Control as well, that state that those, that under recovery could actually, there could be some lighter day on that. I think for the first 9 months, it was around 30,000 crores or thereabouts. Are you factoring this in your estimates? What realistically should we be working with in terms of some compensation for these LPG recoveries?
No, actually, I think, we were pretty hopeful that it would come through in the budget first. And then there was also this news that in the supplementary provisions that were basically announced, it would have some, good news as far as the OMCs is concerned. But as of now, given the uncertainty in terms of exactly the quantum and the timing of this compensation, we frankly are not really building it into our FY25 estimates. As and when it happens, it's something that will probably be more of a positive trigger as far as we are concerned. But right now we are assuming that the 40,000 crore odd of losses that are due, if you build, another 10,000 crore odd in the fourth quarter, I think that will have to be absorbed by the OMCs, at least for this financial year. That is what our base case is.
We'll talk about City Gas in just a bit. Probal, hi, good morning. The standalone refiners, actually Chennai Petro has seen one of the sharpest rebounds in the broader markets, up some 35% from lows, MRPL as well. How's the picture there for these two names? What's the environment like?
We don't track CPCL and MRPL separately. We don't have an official view or rating on it. But what has obviously happened is, if you see the direction of Singapore benchmark margins, they have definitely improved a bit. And specifically, diesel spreads have once again been hovering at somewhere between $13 to $14 a barrel. And that is always good news for Indian refiners, given that close to 50% of our product slate comprises of diesel. And if you consider gasoline and ATF as well, the total proportion is close to 67-68%. I'm talking about average for Indian refiners. Each individual refiner might have a different percentage. But given that whatever strength is coming through in Singapore is being driven by these three benchmark fuels, whatever strength is coming through is obviously good news from a refining margin perspective, because if Singapore is at $4, but it is being driven primarily by strength in diesel and ATF and gasoline, I think Indian refiner margins will obviously be at a premium to that. So to that extent, definitely it's slightly better, directionally than what Q3 trends were for GRMs. And remember that, probably, given that crude volatility has been slightly lower, your inventory impact could also be much lower in this quarter. That is also something that can help reported margins.
All right, Probal, so that is the standalone refiners, and I completely understand you don't have a view in terms of actually coverage on these names. City gas companies, IGL, MGL, Probal, what's the view there?
I think, given after the restoration of part of the, priority gas and the way that gas costs have been moving. We would probably continue to remain positive on these names. I certainly think that volume growth probably continued to surprise on the upside, specifically for MGL and to a lesser extent for IGL in the last couple of quarters. Gujarat Gas, of course, it's a different story because it's driven a little bit with what ceramic industry is doing, what export trends are as far as ceramics from Morbi are concerned. So there, the constraints could be a little bit more external, but certainly from a CNG conversion and volume momentum point of view, I think despite all the constraints that are there in terms of slightly higher sourcing costs and a more challenging gas supply environment, I think the conversion rates and the volume run rate probably continues to surprise, and I think that momentum should continue with the partial restoration of priority gas. What will be, of course, interesting is to look at spot LNG trends, because what is interesting is for the first time in probably a very long time, term LNG prices are now much cheaper than spot LNG and are likely to probably remain so for at least the next 3 to 6 months. So the key to success or the key to margin strength probably would be whichever player can probably tie up much more of contracted long-term volumes rather than having to rely on spot LNG to fulfill the shortfall from any priority gas deallocation or any incremental volume growth. So I think that is something that will be key monitorable at these prices with the kind of volume growth, and I think margin looking slightly better than they were 3 months ago. We would remain positive on the space.
Probal, just 30-second response to this. We were supposed to have a gas glut. So even without these long-term contracted volumes, spot prices, at least from what I remember, beginning of the year, late last year, reading, we're entering a period of a lot of gas. Prices generally, spot prices should be lower. You think?
I think we have seen this story before. If you remember a few years ago when Australia was coming up as an LNG export destination, this was exactly what was being speculated, that there would be a huge gas glut and prices would drop to low single digits and stay there. What really happens is that when prices drop below a certain threshold, the market tends to correct itself by in terms of probably delays in commissioning of new projects. There are shutdowns that happen in projects which don't find it economic to sell at sub $10 levels, and so on and so forth. So to that extent, I think there is always a minimum threshold that spot LNG prices need to be at for these projects to keep running at full tilt. That's one. Secondly, what has happened this year is that the European gas inventory has actually fallen a little bit faster than what has been the trend over CY 22 and 23. So that has impacted the near-term balance in terms of supply and demand. I would still believe that with the capacity expansions that are targeted over the next 2 to 3 years, where I think 190 million ton plus of additional LNG liquefaction is slated to come online by CY 28, you would probably see a normalization and moderation in prices. But in the near term, there have been specific factors that have impacted spot prices, and that's probably why you're seeing them remain elevated probably a bit longer than what earlier estimates were. We would remain confident that spot prices would probably normalize to somewhere around $11-12, but we have never advocated that prices go below 10 and stay there, because that always brings about a swift market response from the supply side to correct it upward, and I think that's something that will continue.
Okay, all right, Probal, thanks very much for the context and the perspective. Appreciate you joining us today. Thank you very much. Have a good day.